Recently, I made a video on TikTok about how I sold my company for $25 million in cash, and I broke down the entire deal, what was paid to shareholders, what I paid in tax, and how much I walked away with. If you haven't watched it, go find it. But it generated a ton of questions about how I kept my tax rate to 30% on this transaction, particularly given that I live in California. So I'm going to tell you how I did it. But before I do that, I want to address the qualified small business stock exemption, which everybody had questions about. They wanted to know why I didn't take advantage of that because it could have saved me a lot of money. We were not eligible for QSBS because we were an S Corp. And we were intentionally an S Corp because in the beginning, when we started our company, we had no venture capital funding, we didn't have a lot of cash, and we really needed the financial benefits that being an S Corp provided. And we took advantage of those benefits for a full 10 years. So now that that's out of the way, how did I minimize my taxes? Well, it wasn't just one thing. It was really a combination of great experts and benefiting from some luck in terms of timing. So the first thing we did is the day the deal closed, we paid state tax of $2.5 million in advance to get a federal deduction. This advance payment ended up saving our shareholders about $500,000. It was recommended by our corporate accountant who was working on our deal, and it's called the pass-through entity tax. Every state is different on how it works, but almost every state has this. But it only applies to partnerships and S Corps, not C Corps. Then there was a matter of timing. Our deal started in September of 21, and it was supposed to close in December of 21, but it didn't. It didn't close until January 2022. And in hindsight, that was really lucky because it gave me an entire year to plan my tax strategy and do different things that could help to minimize my taxes. So I did things like open up a donor advised fund, which allows you to take pre-tax dollars and earmark them for charity, and you put them in an investment fund and they continue to grow. And the only stipulation is you have to give that money to charity, which I probably would have done anyway. I also, apart from the donor advised fund, I made another big contribution to a nonprofit that I'm involved in, and that allowed me to save a little bit of money. I put solar panels on my house and took a deduction there. But I think the biggest thing that I wasn't anticipating that actually worked in my favor is I put a lot of money in the market in April. And I thought that that was good about the bottom of the market, but it wasn't. As we know, it continued to go down. So I was able to do a lot of tax loss harvesting because I lost about $500,000 in the market in 2022. And then something very unfortunate happened in the winter of 2022 and 23, which is that we had these huge storms in California with lots of floods. And so we were given the opportunity to not pay taxes until October 2023 instead of April. Now I had $2 million earmarked for my big tax payment just sitting in a bank, and it wasn't an interest account, and interest was higher than it had been in a very long time, so that was lucky for me. But that additional time that I had was amazing because I took that $2 million and I put it in a 6-month treasury bill and made $45,000 on it, and ultimately paid my tax payment in October of 23 for the 2022 year. So there you have it. It was a combination of great advice from our corporate accountant, from my personal accountant, and my investment advisor. And then it was a lot of unforeseen luck, which you've got to take advantage of too. So my advice is hire the best experts, expect the unexpected, and take advantage of the breaks that you're given. Follow me for more content like this.